Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
So here's the latest this morning. Global bonds seeing their biggest sell-off since May, with the Middle East conflict reigniting inflation fears. Torsten Slok of Apollo writing the key issue is the duration of the shock. Markets may quickly get used to a situation that could last weeks or even months. Torsten joins us now for more. Torsten, welcome to the programme. Does this shock have the potential to become an economic issue in the months to come?
Yeah, because this is a stagflationary impulse. It's actually quite similar to what we saw with the trade war. Prices are going to go up, and ultimately, if it persists, GDP is going to go down. So this creates a huge headache for the Federal Reserve, because the Federal Reserve now needs to assess the dual mandate. Where is the hit the hardest? Is the hit the hardest on inflation? Should they worry more about inflation going up? Or should they begin to worry about the downside impact on the labor market? That's why this is a complicated shock, just like we saw with the trade war, just like we saw with Ukraine, Russia, and just like we're seeing today.
Torsten, relatively speaking, is it a bigger problem for the Bank of England, for the ECB?
Well, the challenge for Europe is that they depend more on energy. The US produces, of course, a lot more energy than it consumes itself, whereas in Europe, we do have a much bigger energy dependency. And that's exactly why markets are trading the way they are, where Europe is getting harder hit, because there simply is a bigger energy dependency in Europe.
How important, Torsten, is it for a stagflationary shock for there to be enough economic momentum in a country to withstand and prolong price hikes?
Well, the challenge, Lisa, is that the starting point is extremely important. Inflation in core PCE today is 3.0. So if inflation today had been 1.0, it would have been a completely different discussion. But now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters potentially, that is certainly a risk that the Federal Reserve needs to take very seriously.
Well, this is a reason why I was surprised, Torsten, in the conversations that I've had with a number of different investors, even companies. They seem really excited, actually, about the opportunities ahead. They think the economy is chugging along. They're looking to invest. The sort of manufacturing boom feels like it's actually getting legs. How much could that amplify the risk of a stagflationary shock, because it could cause the price increases to be more significant in a way that isn't just necessarily a one-off shock from commodities?
No, you're right. And I mean, if you just think about what has happened in the last few weeks, first we were talking about, wow, the US economy is strong. Then we were talking about, oh my God, we're all getting unemployed because of AI. Now we're back to talking about, wow, inflation is going up. I mean, no wonder that the people inside the Federal Reserve are looking at this and probably scratching their heads and say, well, now there's another shock that we need to take into account. But in combination, the issue is still that the US economy is doing really well. We have 3 very strong tailwinds from AI spending. We have a strong tailwind from the Industrial Renaissance. And let's not forget that the Congressional Budget Office, they estimate that the one big beautiful bill will lift GDP growth this year by 0.9%. That's an enormous boost to GDP coming from fiscal policy. So taken together, it is a very strong economy, and it is an argument that has been made by many, including me, that we are at risk, of course, of seeing more upside pressure on inflation. And now you add here in the last few days, on top of that, some more upside pressure because of oil prices. And finally, let's not forget also, if this was just a few days, well, the risk is now that even today, now we're getting headlines about new oil facilities potentially also getting hit. So the challenge here is that, well, what headlines should we then expect over the next several days again? So it really is a complex situation because of this incredible risk that we might begin to see even more upside pressure on inflation from an already pretty bad starting point.
Well, Torsten, let's unpack the bull case for the US economy and the tax component of it. Let's go with tax refunds. And you mentioned the labour anxiety connected to what's happening with AI developments. I think that's a feature of the conversation going forward. Does that hold back people when it comes to spending those tax refunds, given that they're now going to see higher energy bills, potentially higher utility bills, potentially? Does that make them more risk-averse, conservative in the months to come?
No, you're right, John, because last year, if you go and look at, of course, what tax refunds normally are, they were around $3,000 per family. And now this year, if you think about that, the one big beautiful bill is done retroactively starting in January 1, 2025. That means that we have all paid too much in taxes in 2025. That means that our tax refunds will be bigger this year. On average, they will go up from $3,000 last year per family to now $4,000. And there's 129 million households in the US. So if you multiply these two numbers, that's $100 billion more more in consumer spending coming along here potentially in March and April and May. So over the next several months, we're going to get quite a lift in consumer spending. But you're right, if consumers are very worried, they could be saved more, but that's why the key indicator to look at on that is to look at consumer confidence. Consumer confidence has done a little bit better, but are consumer confidence indicators getting impacted by this or not? That becomes very important over the next several readings.
So, Torsten, that feels like much more of a European story, potentially, than a US one. How do you expect central bankers to guide us through this moment? We had some guidance from the Australian Central Bank overnight saying every meeting is live. What do you think the approach will be of, say, the Europeans, of the Federal Reserve, the ECB?
Well, I think it's easier for the Fed because they will probably be more two-handed and say, on the one hand, we have inflation going up. On the other hand, we're worried about what this means for the labor market. It's more challenging for the ECB and the Bank of England because they don't, quote unquote, care about the labor market. They really only target inflation. And if they only target inflation, they should begin to be more hawkish. So that's why it makes sense that rates expectations and central bank expectations are moving more in Europe because the Europeans have simply a different mandate, namely only inflation.
Torsten, does this torpedo the bull case for Europe and frankly for a lot of the ex-US discussion? Because even though, yes, the United States could face a stagflationary shock, other places could struggle with that even more at a time where the market seems to be overly positioned that way.
Well, the challenge for Europe is that the main bull case for Europe is really that Germany has said that they will spend 500 billion euros on infrastructure and spend unlimited on defense. So the question that, of course, is immediate here is to ask, well, what are the Europeans going to do now in the form of defense spending? What are they going to do in the form of more government spending? So the policy reaction becomes very critical. How is Europe going to respond to this? Are they going to say, well, too bad, inflation is just going up? Or are they going to say, well, wait a minute, maybe we do need to do more on the fiscal front? And there is not much room to maneuver on that front, but it becomes very critical that on the policy front, the Europeans are likely going to at least say and indicate more action as a result, in particular if this does become more of a negative risk to the GDP outlook.
Stay with us. More Bloomberg surveillance coming up after this. Let's extend the conversation with US Marine Corps veteran Major General Mastin Robeson of Academy Securities, writing the following: Iran's current ability to make clear and rational decisions is likely disrupted, but proxies are still a problem that is not easily solved. The Major General joins us now for more. Major General, welcome to the program, sir. Always appreciate your insight. Let's just start with your assessment of the operation so far.
Thanks, John, Lisa. So, I mean, it seemed to me that the number one objective was to try to ensure that the nuclear capability for Iran is off the table. And it does seem that part of the operation has gone well. If the objective was to take down mid-range and short-range, or particularly long-range and mid-range missiles and destruction of the Navy, that's gone well. The challenge is the side effects of those, the closing of the straits, the attacks on Middle Eastern countries and their capitals, which doesn't really surprise me because you've got to believe that everything that's happened from the Iranian side of the house over the last 4 days was probably prescripted, that if we get attacked, these are the targets, these are the things you do, which probably in hindsight is not best for Iran to be attacking the other Middle East countries' capitals, because it certainly plays against their ability to have an emotional connection to the Muslim people in those countries and separate them from their governments.
So, Major General, that last point I think is quite important, that the response we've seen from forces in Iran so far has been scripted. As time goes on, how do you think IRGC forces are operating or will operate in a leadership vacuum?
I mean, that's the hard part to predict, because I do think they're operating in a vacuum. I don't think that there's a central government that is, in essence, making the decisions to say, this is what we're going to do next, these are our objectives, this is what we want to achieve in order to get the upper hand. So it is going to be interesting to watch at what point do they have the ability to name a government, and then even after they name it, does it have any control? given the amount of destruction that's occurred to their network, do they have the ability to control their military, or is their military pretty much now in isolated bubbles doing what they think are best without any centralized control? And that has a danger all to itself. But it also means that they're not going to be unified in objectives to be able to try to disrupt what the coalition right now is trying to accomplish.
Major General, I wonder what we're learning about the nature of modern warfare in terms of the way that drones are being used and deployed by Iran and the asymmetry in pricing, right? These drones are cheap, they are multiple, and they are quick to produce. And at the same time, some of the missiles that we're using to shoot them down cost tens, hundreds of thousands of dollars. I mean, how is that mismatch playing out? And how could that be something that shapes the nature of war going forward?
Yeah, you're absolutely right, Lisa. We the U.S. have to figure out a better way to do this. We've got to figure out a cheaper way to do this. It doesn't make economic sense to do what you've just described with $1 million missiles shooting down hundreds of dollars drones. So it was fascinating to me to see that President Zelensky had offered to help us figure that out better and help Israel figure out better if they could convince, and the Middle East could convince Russia for a 30-day ceasefire. So who knows? I mean, that may happen.
Well, Major General, the way that war is being fought is so different. In this case, there's a concern that retaliation could come in the form of cyber attacks or other types of disruption. How are you monitoring that, given the fact that it could be kind of one-off events in different places? How well protected is not only the U.S., but also other Middle Eastern countries against that type of attack?
I think we're pretty well protected. I mean, there's no way that you're going to get 100% protection. But I think let's remember that even though this is a 4-day war that's been ongoing now, cyber attacks and penetrations have been a serious threat for years. And by and large, even though Iran has the capability, their capability pales in comparison to some of the other capability of nefarious actors that are out there in the world, who certainly could insert themselves into this in a disruption type style. But I'm not sure it's to their advantage. It appears at this point that the Chinas and the Russias and the North Koreans are content at this point to sit on the sideline and watch this play out. And that's our advantage if that happens. If it broadens and they become part of what you're describing, a cyber type offensive defensive war, then that does complicate things for everybody. But I think we have a better defensive architecture than probably we're willing to advertise for obvious reasons.
Stay with us. More Bloomberg surveillance coming up after this. Of course, the main focus this morning remains on the rising tensions in the Middle East. Shipments of oil and other goods passing through the Strait of Hormuz have come to a virtual standstill. The Flexport CEO, Ryan Petersen, writing, what began as a regional security crisis has now become a direct disruption to global supply chains. Ryan joins us now for more. Ryan, welcome to the program. Thanks for making time for us. Just how much capacity have we just taken out?
Well, on the container shipping side of things, you see there's 67 ships that are inside the Strait of Hormuz right now. A lot of those are smaller ships, so it looks like 0.6% of all the container shipping capacity in the world is taken out. That is the equivalent of the idle fleet today, and idling is one of the main ways that capacity can be controlled to kind of keep prices in place. Is if there's too much capacity, you idle ships. So it's a bigger deal than it sounds. And what's going to really play out here is that the major container shipping lines, and I've spoken to 3 CEOs of the Big 10 ocean carriers in the last 48 hours, that most of them have either paused bookings to the region or really diverted. They've all stopped shipping inside the Strait of Hormuz, but many of of them and said, hey, we're not going to take any bookings. And so what that means is these containers are going to sit at ports around the world, especially in East Asia, China, and Southeast Asia, and not move. And so you're going to start to get real congestion at those ports. And we've seen this movie before where that congestion can lead to spikes in prices and all kinds of problems.
So, Ryan, let's talk about that. Some people reflected on the energy shock of 22, the conditions coming out of the pandemic. Are there parallels here for you?
I mean, the history always seems to rhyme, and it is about that congestion and how it flows through the supply chain and builds up in unexpected places. And now it all depends on how long this lasts. If it lasts for a long time, you're going to see major reroutings. In fact, Flexport is one of the largest providers of ocean freight in the world, and we built this new product called Atlas. It's atlas.flexport.com, where you can monitor all the ships in real time and see where they're sailing. And so it's actually going to be a big challenge for us to see, can we keep this thing up to date as the ships get diverted, as services are less reliable. We have seen that movie before, so yeah, I would expect to see the services start to degrade and be more difficult to operate.
Ryan, you've got great visibility on these things. As the dominoes start to fall, are you thinking about secondary bottlenecks that might emerge as well, and where might they emerge?
Yes, I mentioned a few of those in unexpected places like congestion, but you're going to see pricing be a global phenomenon here. Ocean freight prices, we're right in the middle as contracting season is just starting to kick off, and all the ocean carriers have told us this week, not all, but most of the ocean carriers, and I think it'll be all pretty soon, have told us that all previous discussions on ocean freight contracts for this year are out the window, that there's too much uncertainty and they expect prices to go way up from where they are today. We're already hearing rumors of $5,000 a container from China to the U.S. East Coast, which that's more than double where it's been for the last few months. So yeah, we're already seeing big spikes, and that will lead to all kinds of secondary effects.
Ryan, some of that, as you know, might just be a reflection of extended transit times as well. Could you give us an idea, as some of this traffic reroutes, what the extension to transit times might be for, say, traffic between Europe and Asia?
Yeah, well, in the ocean market, it's really just which of these strings, these services call in. Jebel Ali is the 9th largest port in the world. Abu Dhabi has a large port. There's several other important ports inside the Strait of Hormuz. So the first thing is, okay, which services call there? Those are going to be heavily disrupted, because they're going to have to stop and unload all of those containers. One of the ocean CEOs I talked to said they were going to unload in Oman, but of course the port of Oman got hit with a missile yesterday too, a ship near Oman. So it's really difficult to say exactly how each carrier is going to reroute things, but that will for sure lead to service issues. Let's not forget the air freight market. Whereas the Middle East is a major hub for air freight, we estimate around 18% of all the global cargo capacity for air freight has been taken offline just temporarily. We haven't seen planes get shot down, but temporarily. And a lot of, you have Emirates and Qatar, Etihad, all of these are major cargo airlines that operate in that region. And Asia to Europe flights tend to go over, either stop in the Middle East or fly directly over Iran. So just big disruptions to the air freight market as well. And there, it's a relatively capacity constrained market in general. You can see huge spikes in price from a small disruption in capacity.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.